Hi and welcome to the Market Alert for Monday, the 5th of June 2023. So over the weekend, Joe Biden signs the critical deal to raise US debt ceiling. So they're still going to raise the ceiling, they're just not going to publish it till the 1st of January 2025. But anyway, as I said weeks ago, that they wouldn't let it go past this date, and it's now we're done. That's tough. Another $4 trillion to be added to the debt. The market thinks this is good. Futures jump as Senate passes debt deal. China plans new stimulus package, so bullish for stocks. Interesting article here on the Bloomberg site. $1 trillion Treasury vacuum coming for Wall Street. Post deal supply surge will rumble through stocks to credit. Already eroded liquidity set to shrink by $1 trillion, according to JP Morgan there. And as it says here, that with the debt ceiling freshly signed into law on Saturday by President Joe Biden, US Treasury is about to unleash a tsunami of new bonds to quickly refill its coffers. This will be yet another drain on dwindling liquidity as bank deposits are raided to pay for it. Well, there's a problem with the deposits already, and Wall Street is warning that markets aren't ready. So that's today when that happens. We'll just have to see. Or is it one of these headlines where they like to create the panic and the fear and then nothing happens? So I thought I'd just let you be aware of this one. And Friday, still European equities trade on the forefront following the Senate passage to debt ceiling bill. And then, of course, we had the payrolls as well, which the market, despite the fact that they were very hot, the market moved to the upside after hearing this news as well. So we don't believe this number changes the dynamic for a skip at this month's Fed meeting when looking at the fine details. According to this particular commentator, the core numbers still don't see why the Fed should pause this next month. It's just going to get worse if the Fed continue to raise rates, especially now there's another $4 trillion to service at a higher rate as well, and of course the impact of that on the banks as well. Economic news for today: ECB Lagarde at 2 p.m, so there's nothing today, and in fact 3 p.m. ISM services from the US, but there's not really anything this week. If we have a look, as you can see there, nothing for Tuesday, Wednesday, Thursday unemployment claims, and then nothing until next Monday. So that's it. So the market's free to move to the upside if it wishes to do so, because there is no economic news to cause the market to fall. The only thing is, like I say, is this situation here, if it does have an impact, so or something else of a geopolitical nature. So what else is there to move the market to the downside based on what happened on Friday? So let's have a look at Friday's markets and see what happened with regards to the Dow and all of the other markets. So in the Dow, we see a massive move there. I think it was 647 points. We'll check in a second. You see a big move to the upside overnight. The first hour, the markets are still moving to the upside. That's between 11 and 12 midnight. And since then, the market showed a bit of weakness. But on Friday, after the release of the non-farm payroll numbers, this is here, all the way up. And then the deal as well. Yeah, 674. Not 47, 674 points move for the Dow there during Friday. So we can see a massive move. Markets coiling sideways, sitting at the close. Just need to take out the high and then continue to the upside. Back to the daily chart from this high down to here. Put in the new fibs as we've sailed all the way through these. We're through this one. We're through this one. And the 62 as well. Got to get through the 78, 89, and then you've got this high to the left here where the market will need to get through, and that's at 34,261. So 34,250 psychological level is easy to remember. And there you've got 34,000 as well, and then 33,900. If you want to round these numbers up, it's just easy to remember. So that's the upside. Downside, just in case what Bloomberg report there does come to fruition, there's the downside target as well, with the 5-bar moving average sitting at the 38 at 33,402. So I'll save those and we'll see how the market pans out with that. But 30-minute chart at the moment, coiling sideways, finding support, and looks like it wants to race to the upside. May have a shakeout to begin with, but on the whole, the market wanting to move to the upside, and it's no news this week to stop it otherwise. And in the German DAX, we see the market trade up to the 62% retracement. That's drawn from here back to here. And you can also see, of course, that we've got a bit of a double top situation going on there at 16,064. Market up in the first hour, down overnight for the remainder, but as you'll see there, this too also finding support, ready to come back and go through the high. Friday, you see just a one-way street. We had a bit of a pullback there with the numbers from the non-farm payrolls. Market shook out and they just bought straight back in. Look at the volume there that bought this market. And then it continued up with the Dow. And like I say, overnight, the market sideways to higher there. Friday's 5 minutes. Let's just drag this over. Now you can see the shakeout from the non-farm payrolls. We'll come back to that in a second. And there you've got the start of the day, all sitting at the 50 EMA. You can see the market testing there. We were overbought with the momentum starting to shift to the upside. Then we get a pullback to the 20 bar moving average and the R1 and oversold. And then we move back up to overbought. We pull back to oversold. And then we move back, creating just go through a double top there with the momentum starting to drop off. And then you'll see the market react to the non-farm payroll numbers there, as prices then trade sideways, wait for the Dow, and then off they go to the upside. We have a pullback, and then we got demand crossover, and then we just continue back to the upside there. And overnight, the market sideways. We can see already they're just starting to buy into the market. This is 7 a.m. I'm a bit later this morning. There's so much news to get through. So through the close, and then the high, which is just a stone's throw away. And again, if you go back to the daily chart, that will then start you on the road through to 78 and 89. And this will be the same sort of pattern in all of these markets. One other thing that I need to mention is the implied volatility. We have a new low, and we haven't had this sort of low for a very long time. This also a catalyst for the market putting in a correction. Whether that starts from today with those treasuries, who knows? But in the 6-month chart, you'll see that we haven't got an 1147 in here, 1148, sorry, in here at all. We have to go all the way up to the long-term chart to find anything remotely like this, which goes back to 2021, which is a precursor to a correction in the market. And then we had further corrections thereafter as well. So this is a very important level. Lowest I've seen it, like I say, since 2021. What date was that? Let's just have a quick look, see if we can get it. August 21, 11th of August 21. So very interesting picture developing there with the implied volatility. Like I say, due for a correction. We have had these minor ones where we've come back to these lows, and you've seen them there. But this is a big number. But given there's no news this week, we could see this number move lower, and the lower it goes, the bigger the correction will be. Keep that in mind. Like I say, this doesn't mean to say there's automatically going to be a correction in the market, but you will see that when we drop to these lows, you do get these. When you look at it this way, you will see that you do get those corrections following. You just might get a rally back in the daily chart first, and then once it fails at 89, let me show you what I mean. Go back to this one. So let's say this is the all-time high in the DAX. If we get back to this level and the implied volatility has dropped down to 10% or whatever, then be warned about this type of area, because you're likely to see the market then move to the downside. And in the S&P, we can see the market there continuing to do the same thing, moving to the upside. Bit of weakness overnight as well, and also down slightly. We've got a 30-minute chart there, same thing, coming off the high for the non-farm payrolls down towards the close. A lot of buying coming in, and then off we go. And then overnight the market sideways, needs to get above the close and the high. In the FTSE 100, also trading up to the 89 that we drew in on Friday. We're sailing through all of these other fib retracement levels, so we're going to take out the high to the left, and then we can draw in the new ones here to here, and we'll scrap those just for a second so you can see where we are. So we're through the 50, 62, 78. You've got a couple of averages in the way there, and the 89. And in the 30-minute chart, it was a one-way street on Friday, with this market moving up 120 points and already close to taking out Friday's high for the FTSE 100. There are no trade updates for last week. What I made on Thursday, put in Thursday's market alert, is final because unfortunately I couldn't be at the desk on Friday, so the profits remained from last week, which were 664.50 there, which you can see down at the bottom right there. Okay, let's move on and have a look at the currencies. And in the GBP JPY, this moving up on Friday and sideways overnight. The 30-minute chart, you can see how sideways it is. This is the reaction to the non-farm payrolls, but since then the market's been sideways, even on the Asian session. In the pound, this moving up on Thursday, Friday moved to the downside as the dollar moved higher with the completion of the debt ceiling deal. A bit of weakness there at the moment, depends how the dollar fares later. 30-minute chart, you can see we managed to just trade sideways. Then we had a sell-off initially for 30 minutes, tried to buy back, and then the market moving to the downside. There was no change in momentum. The market wasn't having it. Dollar up, pound down, and we've already taken out Friday's low there for the pound. And in the US dollar, surge on Friday and moving up on the overnight as well. I'll be inclined to, or be interested to see if the market can actually get up above an 89% retracement in the dollar as the impact takes hold in the markets with regard to this new $1 trillion worth of bonds that are going to flood the markets today. So it'll be interesting to see if the dollar actually holds. And in the metals, silver getting hammered on Friday, getting hammered overnight as well. As you can already see, we're already below the low. But Friday, you can see there that the non-farm payrolls having an impact. Dollar higher because it's perceived as good news when it isn't actually good news when you're in a rate raising cycle. You want the numbers to show a contraction so that you can say that the interest rates are having an impact and stopping inflation. But according to the news, 339,000 new jobs were created, which was interpreted as bullish by the US dollar. So you can see we're already through the 200 MA there in the S1. Unless this turns around, but it's not looking too bright at the moment. So you might get a few days where the dollar rallies before you get another turnaround in this market. So there's the downside targets. And you've got that low that could be retested with the 200 MA as well down here at 22,664. In the gold market, similar picture, hammered on Friday and also being hammered now as well. We'll just draw in the Fib retracements on that one. 89 is $1937 for gold, and in the 30-minute chart, we're already through the low of Friday as well and still looking fairly weakish there. Market's response to the non-farm payrolls, dollar spikes, gold gets monkeyed to the downside there. And finally, in the gold-silver ratio, silver's outperformed gold for the last 3 sessions there, but overnight, gold a bit more stable than silver. Okay, that's it for this one. Let's see how the market copes with this $1 trillion onslaught of bonds today, new bonds going into the market at a higher rate, and what effect it's going to have medium to long term on the bank deposits as the Fed may continue to raise rates as well. Okay, that's it for this one. As ever, thanks for watching. See you in the next.